Don't miss this. If you're listening to this, don't miss what I'm about to say. So, the furthest distance in the universe is the distance between your head and your heart. And by the way, I've made this mistake. The checkbook's in your hand and you're
Yeah.
writing a check.
Not make impulse investments.
I've actually switched the order now just to protect myself because I've made some bad investments. So, the three little things that I look for: do they have a top 10 auditor?
Welcome back to Graceful Investor. My name's Tasia, and I am so excited today. We are joined by my good friend Bo Parfet, and he is going to be talking to us about his own private investing journey and things to look out for as we look at different deals along the pipeline. Welcome, Bo.
Thank you for having me. It's an honor to be here. We're going to have some fun, I think.
I think so too. Okay, so just kind of briefly introduce yourself.
Hello, everyone. My name's Bo Parfet. I am 48 years old. I live in Boulder, Colorado. We're blessed. We have a place in Steamboat, Colorado as well. If you haven't been to either of those places, check them out. I am married to Meredith Parfet. My wife is a hospice chaplain, but she's also a crisis management expert. So it's a pretty, and you can kind of see there's a parallel there. So she runs a cool company called Raven Yard. And then we have two boys. They're 14 and 10, and they love to ski. They love the outdoors. They love to mountain climb. So that's a little bit about my family. We're lucky where all the grandparents are still alive. We're blessed there for sure.
Wow.
I work at DLP Capital, which is an impact company, which is pretty cool. And we're trying to solve the attainable housing crisis. And on a personal level, I love to climb and ski down big mountains. So I'm officially nominated to the 2026 Colorado and Michigan Ski Hall of Fame. So hopefully it's
Congratulations.
an exciting year here. Tasia.
Yes, I know that's a big part of your life, and you definitely weave it into your profession as well. So, one of the things that I know I wanted to ask you about is because this channel is for women, could you talk a little bit about the dynamic that you and your wife have around investing and how involved is she and any advice that you have there?
Absolutely. Absolutely. So about, I'm going to say somewhere 12, 13, 14 years ago, I had my first liquidity event. And then I said to Meredith, I said, we've got some dry powder or some capital that we can deploy and do good work with. But what do we do? So we asked a bunch of people, what do we do? What do we do? And a lot of people said, well, create a 501c3, create a 501c3. And not to say that that's not a bad answer, right? That's a good outcome, right? You can set up a nonprofit, a family foundation. Where we ended up was creating an impact kind of LLC. So it's called Denali Impact org or .com. If anyone is interested, the website is denaliimpact.com. Another cool one is called impactassets.org. There's a lot of cool private impact investments on there. We wanted to create something that was sustainable. So we did it together. So we created this impact portfolio together. And working with Meredith and our two boys is pretty darn cool. But I will say that one of the things that we did, this is maybe 6 or 7 years ago, and I learned this from a mentor. Somebody said, Bo, do you know your wife's lifelong dream? And I was
Hmm.
like, oh my gosh, I don't know the answer to that question. And then he asked a bunch of other people in the room, and no one knew the answer to that question. So I went and asked Meredith. I said, well, I came running home and what's your lifelong dream, right? I mean, it's a big question to ask. And
It is.
and some people know it, right? I mean, some people, hey, here it is. I've got the one or two sentences. And other people need to think about it. So she had to think about it, knowing that, and she also wanted to know mine. But knowing her lifelong dream was a very important kind of first step. And then the next thing that this kind of mentor of mine taught me was you need to know what are the 5 or 10 things that are the most important to your spouse. What are the most important things?
Around what they want to be investing in.
Yep. Yep.
Yeah.
Around generally that, and but you can tie it all in. So like one of her things is she wants to be surrounded by nature. That's one of her top 10. Well, great. Nature is environment, right?
Hmm.
Nature is making sure the environment is well looked after. So there was some parallels we could draw. So we used a lot of that kind of history and values to create our impact investing entity.
I like that. Okay, so I hear you saying that you and your wife really had to sit down and decide what is important to you, translate it into what type of investments you want to be making. And I really like hearing that you do it as a team. I wanted you to talk a little bit about what is impact investing and how that has really shaped you and your wife and your approach to where you put your money.
So impact, you have to do two things at a high level to make it be an impact investment. Number one is you have to solve a bona fide problem in the world. You got to solve a real problem. Okay.
Okay.
And then number two is you have to have a financial return on that investment. You have
Hmm.
to have both to be an impact investment. Okay. That is what impact investing is. And then what I have seen, Tasia, is that some families galvanize around one thing, right? So grandma died of cancer, right? Or grandpa died of a specific type of cancer. And all of their impact investing is around solving and curing cancer. This could be
Mm-hmm.
biotech companies. Maybe you put a little in public pharmaceutical companies that have a big cancer division, right? You could diversify. And that's totally cool, right? That's totally, I get that. Or other folks can go like, hey, actually, I want to build a diversified portfolio. I want to have some private equity in there. I want to have some venture capital in there, some public markets, some debt investments that are all kind of making impact. So there's not really a wrong answer. It's what feels the best to you and your family.
Okay, that is a wonderful explanation. Thank you. I am curious. You mentioned that you have the Denali Fund, which is where your cash initially was put into it, and then you deploy it from there. What percentage of your personal portfolio, of your investable portfolio, would you say is in private investing versus other kinds of investing?
Let's unpack this a second. So we have a kind of call it an alpha portfolio or a non-impact portfolio, and we
Correct.
have an impact portfolio. I did a TED talk 2 days ago, and one of the lines in my TED talk is, "We are here to enjoy people's journey and not judge it." Right? So everyone who's listening, there's not a wrong answer here. We have about 50% of our investments on both the non-impact portfolio and the impact portfolio are in private investments. So it's about 50% private and 50% public.
And how long, when you're thinking about your private investing, are you comfortable having the money kind of locked up, can't be liquid, and you're in it for a longer term?
This is a very thoughtful question, and it's one that people wrestle with. Boy, we wrestle with this one.
I
How
know.
long are we going to have our money tied up? If a family is thinking, hey, this is going to be a multi-generational kind of
Mhm.
investment, or we've created a family foundation, or it's an LLC that does impact, and we're going to make investments today for people who aren't even born yet, right? This is
Right.
our great grandkids. Then if a family chooses to take that mindset on, there are things that your money could be locked up for 10, 20, 30 years.
And
Okay.
is that what you and your wife have kind of done?
We've wrestled with that. Our longest lockup investment is about 8 to 12 years. It's a private equity investment that makes private equity investments in women owned businesses. Okay.
Okay. And is that more of a fund model?
It's a fund model. Yep.
Okay.
And primarily outside of the US, but it's a really cool fund. And we were okay with that 8 to 12 year lockup. But most of the portfolio has two has a liquidity of 1 or 2 days to 2 years. That's
Okay.
just what felt better to us
Yep.
because we could kind of pivot. Yeah.
Okay.
That's a great question. If someone's trying to lock up your money for 10, 20, 30 years, that's a big deal, everyone. You really want to think about that.
Right. And there are, I mean, there are some companies that want that, like pharmaceutical companies. It might be a very, very long time frame if you ever get your money back. So I appreciate you sharing with us. So, all right, so let's get into kind of the nuts and bolts of how you look at an opportunity, because it sounds like you definitely are tapped into quite a lot of different areas. And I'm curious, when you first see a pitch deck or an offering document, what are the things that you immediately look for that you say, this is definitely line with me if it does this, this, and that?
Okay. Don't miss this. If you're listening to this, don't miss what I'm about to say. So, the furthest distance in the universe is the distance between your head and your heart. Okay. So, when you hear about a private investment or an impact investment, if it's speaking to something that breaks your heart is going to jump in really quickly. And
Mm-hmm.
and by the way, I've made this mistake. Oh, hey, you just next thing you
Oh,
know, the checkbook's in your hand, and you're
yeah.
writing a check. Okay, so but we have to slow that down, right? We have to slow that down, and if we're going to be thoughtful and good stewards of our the resources for for our family and hopefully generations to come, we have to merge the distance between our head and our heart, and we have to make good decisions.
Not make impulse investments.
Yep. So
So, what
three
are the things you look for?
I used to answer this question to say the two most important moments of your life are the moment you're born and then the moment you know why. So I'd always want to know why. Why is this company in business? What problem are solving? I used to go there. Okay. That's kind of a heart question. I've actually switched the order now just to protect myself because I've made some bad investments. So the three little things that I look for, and they're really quick to do they have a top 10 auditor? So an auditor is a CPA firm, an accountant that has you want to make sure they have that CPA credential, and you want it to be a top 10 CPA firm. You don't want it to be, a one person band, right? That's doing this thing. You want to have a very big company that's going to put their brand equity, their brand behind it, and all their expertise. They're going to come in and they're going to audit the books. And what that means is they're going to verify the books and records. So
Mm-hmm.
the company that you're considering investing in, they tell us, oh hey, we made 10% last year, right? And here were our margins. And here are some things, here's a couple deals that went south. Here's the 18 that went great. You have to have a third party verification,
Yep.
right? President Reagan said a great thing. He said, trust but verify.
Yes.
And it's
So
okay.
okay, so that's the first one.
Yep.
The An
So,
actual auditing company
yep.
that you can say, could I see the audited financials?
And if they have a top 10 owner, that's a really good sign. Then we can go to step two. If they don't have one, everybody, it's a red flag. I mean, it just is. Okay, it is because no one's verifying. No one's verified.
Startups, they might not have
Yep,
a track record just yet, or
that's right.
the
Yep,
funding to pay for that type of service. So you're right. It
yep.
is something to definitely be aware of.
No, let's put a pin in the startup thing for a second. Okay, can we come back to it? So
Hmm.
remind me. So because it's a great question. So number one, top 10 auditor. Number two, and don't miss this. Do they have a 3-year audited track record? 3 years of
Okay.
audited track record. Now, why 3 years? Bo, why did you say the reason? 3 years. Because most endowments, institutions, really knowledgeable investors, they know this key thing. And the key thing is this: most businesses don't even make it 3 years. Okay.
Correct.
Now we could Google how many businesses fail in the first 3 years. I encourage you to do it because once you Google it, you'll remember it. But let's just say it's 90%. It could be 95, it could be 85, but let's just say it's 90. We're close. If you make an investment within the first 3 years, you have a 10% chance that it's going to work. Like that. I mean, that's what if it's like, oh, it's a 10% chance of rain.
So you're looking at longevity of the company, how long it's been around, how long it's already been generating revenue, and then what is the third thing that you think investors should look at?
The third thing that they should look at is how their assets under management. Some investors say if you don't have at least $500 million of assets under management, then I'm just not going to look at it. And then other people say you got to have at least $1 billion for us to even look at your pitch deck.
That usually is happening if you're raising a large fund,
Mm-hmm.
right?
Yep.
Okay. So I just want to clarify what kind of company would raise 500 million. It's if they're running funds, right?
Yep.
I just want to be
Yep.
upfront.
Yep. Yep. A fund, it could be a public company. Do they have a $500 million market cap? Okay.
Hmm.
There actually are some good private equity funds that just say, hey, we only raise a $200 million fund because we like to do smaller deals that aren't on the
Correct.
radars of the big ones,
Hmm.
right? If it's their first $200 million fund, I'm happy to just sit and watch, right? I want to see what they do. Now they're on their second $200 million fund. This is where
Hmm.
it gets a little bit nuanced. You're like, okay, their first $200 million fund did really well. It was a 5 to 7 year fund. I could read the audit reports every year. Okay,
Hmm.
great. This 200 million will take them to 400 million, right? Which is close to that $500 million threshold. Okay, all right. Hey, I'm gonna probably take a look at it. So the reason why having a lot of assets is important is this is because when a company is first starting out and they don't have, they're not big yet. They don't have a 500 or $1 billion assets under management or market cap. They're still growing. So maybe they don't have a head of HR. Maybe they
Hmm.
don't have a COO yet. Maybe they have a fractional CFO, right? They don't even have. They're still struggling to figure out their processes and procedures or their
Hmm.
SOPs, right? So they're basically going to learn on your dime. They're going to
Correct.
make a
And
lot of mistakes.
I would like to say I agree. I think I do hear you say the third thing is kind of make sure that they have a track record and you want to verify that the returns are actually hitting the way that they're claiming that they are. And that is true when a company's raising their very first fund, they're kind of building it as they go and building the car while it's moving, I'd say. So
Yeah,
it is a lot more security if you're investing in fund number three, number four, number five. Yeah. I did want to ask you sometimes when you get a pitch and they say a lot of different language, I'm curious if you could kind of help break it down for what it means. What if somebody says it's a 2 and 20 kind of fund with an 8%? Could you explain what that might mean?
of course. So when people talk, oh, we're a 2 and 20 and there's an 8 pref, here's what this means. So let's just say that, to keep the math simple, it's $100 million. Okay.
Okay.
So 2%, the 2 and 20, the 2% is the management fee.
Okay,
So
$100 million does not come from one person, right? You're talking about they have raised 100 million from a bunch of different private investors,
yep.
and the two means what?
The two is, let's just say us, right? The investors.
Hmm.
2% of the $100 million they raised, and thank you, they raised the money hopefully from a lot of different people. And so that's $2 million a year. So what is that? Well, they're going to pay their people. So that's salaries, that's their office space, it's their insurance, it's their electrical bill, it's their overhead, it's their travel to go and find deals and do things like that. Okay. So what they say is that keeps the lights on. Okay.
Okay. So if I made $100,000 investment, every year they would take $2,000 towards their overhead.
Correct.
Got it. What does the 20 mean?
The 20 is called carried interest or a profit share. It's the percent of profits that they're going to take after, and don't miss this, after the investor, and it should read this way. Okay, so we totally, everyone's following us so far. Hey, that 2%, they have to run a business, they have to pay salaries, okay, provide healthcare. Okay, I got it. Now the next step is we're the investor, right? The $100,000. Let's use that. Let's stay with your example, okay? I want to get basically my $100,000 back first, right? I want to get it back
Hmm.
first.
So
Yeah,
return of capital.
yeah,
Hmm.
return of capital, and then I want to get a preferred return. So the first 8% of the profits come to me, the investor.
Okay.
Okay,
So that's what the eight means, the
that's what
8%
it's a preferred
preferred.
return. It means we get
Okay.
the first 8% of profits come to us. That's pretty
Okay.
darn cool. That means if they should be pretty confident because if at the end of the day, if they only made 8%, all they have made is their management fee, right? And the 8%, the return of capital, the 8% just comes to us. Now let's talk about the 20. So every dollar above the 8%, 80 cents of every dollar goes to the investor and 20% goes to the manager. That's kind of their incentive. Like that's a it's a bonus thing It's a bonus or carried interest for them or profit share. It has a lot of different names. It's basically a 20% of the profits go to them because they did all this work and they're going to share in the profits.
Yes. Okay. Could you also clarify, because I know that you raise for your company's funds, what about if it's longer than a year? If it's taken 5 years before the investor gets their money back, does the 8%, is it total? Is it every single year? How does that work?
Some funds will call it a cumulative 8%. So it's 8% every year, right?
And are they actually giving you a check every year, or are they kind of holding it till the very end?
They're holding it till the end until everything is sold. Yep, it's a good question.
Okay.
And then some funds will say it's an 8% cash. It's called, this is a technical term, it's called MOIC, multiple on invested cash. Okay.
Okay.
So let's just do the math. So I invested 100 grand in year
Yep.
one. Okay. In year one. Now it's 5 years later.
Mm-hmm.
Okay. So they've taken 10 grand, right? 2 grand a year on their
Yep. They
management fee,
out. Mm-hmm.
right? But my investment's still 100 grand to be clear, right? So it's 100 grand. Now at the end of 5 years, now they sell it and they make 20%.
Okay.
Okay.
So what I hear you saying, if I did $100,000 investment, took me 5 years before they had a successful exit, and I was going to get that initial investment back, plus $8,000 of the initial profit, 8% preferred return. And how is the remainder split up? 80/20, right?
Yep.
80% to me, and then 20% of the remaining profit to them. So when you're explaining from the beginning 8% return, it doesn't mean every single year they're going to be mailing you a check for $8,000 on a $100,000 investment. It just means 8% total. Doesn't matter how many years it takes to get to that number. I think that that's important for women to understand because they hear the 8%, but it might take you 5 years to get that. And compared to the general market, that's not going to keep up with the regular stock market returns usually. So, what you're really hoping for is the big profit at the end is so great that it washes everything into a normal kind of return over a 5 year waiting period. Would you agree with that?
I totally agree with that.
Okay.
And the average stock market return, right? But you have to remember
Mhm.
take out some fees for that because you generally often the financial advisors take their 1% fee or whatever it is. So the average stock market return is just say it's 8%. Okay, it could be 7.5, could be 8. We could debate it depending how far you go back. If somebody's trying to tie your money up for 3 to 10 years, it's called the illiquidity premium, meaning I better get a really good return because my money's going to be locked up. It's illiquid. And a lot of people are like, if I can at least get, you know, 2 times my money, right? Or at least a 20% IRR, then I'm
Yep.
I'm not even gonna bother. Why bother?
Could you tell me what IRR stands for?
Sure. It stands for internal rate of return.
Okay.
And it's basically your kind of a, an annualized return if you held the investment for 10 years or 5 years or 15 years and then that thing is sold, it takes into account all the years you had that investment. Okay.
Mhm.
So a lot of people like, hey, if I'm going to invest in a private deal, I want at least a 20% IRR. Okay. Another way to look at it is to say, if the stock market's going to double my money every 7 or 8 years, okay, well then I clearly want to beat that, right? I want to get at least 3 times my money, right, in 7 to 8 years with a private investment, or four
Mhm.
times. Now, if somebody says, "Oh, it's going to be a 20 times in 7 to 8 years," that's obviously like, wow. I mean, that's
What
kind of
is an
incredibly risky.
So if somebody is pitching us and saying our other funds have had an IRR of X amount, what would you say is a good number that women should say, oh, good, they know how to deliver that?
I would say if it's a private investment,
Hmm.
it's usually, here's the other thing. They a lot of them say, oh, this is going to be just say a 5 to 7 year investment. A lot of them say that it's 5 to 7 years. When you read the fine print, they usually have 3 1 year extensions in there. Okay, so it actually could be 10 years. It's just important to know. And that's good and bad because here's how it's good. If at the end of 7 years there's a big recession, okay, and the valuations of businesses have gone down, you may want those 3 years to have
You
it
may
come
want
back.
them
You may
to
need them.
stay,
Yeah.
yep, stay in the market longer and don't sell when it's at a low value. Hmm.
Yep. But IRR can be a little tricky, okay, and it can be a little misleading. So don't miss this piece. It's a data point. If their forecast is, hey, it's going to be a 20 over a 20% IRR in 5 to 7 years. Okay, that's fine. But the next question we have to ask is, what is my MOIC? I mentioned this before, but we're going to say it again. Multiple on invested cash. Or another way to say it is, what is my cash on cash return? If I invest, and just ask them, I invest $100,000, when it's done, when this investment is done in 5 to 7 years, how much cash will I actually got back? So if they say it's 300 grand, great, that's a 3x, right? That's a 3x return. Sometimes they'll say, oh, it's a 1.4. And you so like, wait a minute. So I invest 100 grand, right? And I'm going to make 40,000 bucks or something like that. And you're like, over 5 to 7 years, but the IRR looks really good. And the reason how that works, just so you know, is is they will return. They can do a refinance. They can give you some money back faster. Oh, we sold something very quickly, and but it's just not it can be misleading. So probably the key number to ask, I think, in my humble opinion, would be what is my return on the multiple on my invested cash? I'm going to invest 100 grand. How much am I going to get back? Right?
Yep.
And it's a
I love
forecast, right? Yeah.
And that is a question you can ask if you're investing in a fund. So, Bo, if a woman is listening to everything you're saying and says, this is a really attractive way of looking at things, especially around impact investing, what is something that she should be doing to try to replicate the kind of success that you've had with private investing?
If you're just starting off, okay, there's a bunch of things to be mindful of. Okay. So and I'm just going to list many of them, not all of them. But a great thing to do is first thing is never put all your eggs into one basket, right? You can phase in your investments over 1, 2, 3, 4, 5 years, right? We're learning here, right?
A
So
bunch
make
of different companies.
yep,
Okay.
a bunch of different companies. If you have $100,000 to invest or $500,000, you can make a bunch of small investments and just kind of get up to speed that way. So please don't put all your eggs in one basket. The other thing and we still do this today at Denali Impact, our little entity, we like to see who else has invested. Okay, and if there is like an endowment that's invested, anyone, Ron Cordes is a very famous person in impact investing, and he has the Cordes Foundation, which is you can go to his website and see what he's invested in. Impact Assets is a huge nonprofit, and they have tons and tons of impact investments on their platform. That's public. You can see what they are. They do a pretty good vetting process. So see what other people have done, and it's okay to ride the waves of somebody else's due diligence. Remember, we only have so much time. If you're a busy mom or a busy female professional, right? You're busy. So how can we leverage our time? That's a big one. And then the other thing that just to be mindful of is a fund is going to be more diversified and kind of easier to get your arms around than making a single investment in one asset. Okay.
Correct.
So if
Yeah.
you're just starting, I would lean more towards a fund because they're more diversified And generally speaking, they're safer as it putting all your eggs in just one basket on one deal.
I would agree.
Yep.
And I have definitely had to learn that the hard way. If you could say it again, the idea of the impact investing website that has recommended places to put your money. What was the name of it?
Impact assets.
Impact assets. Okay.
Great spot. You could just, it's a great spot to learn. There's great impact companies on there. And to make it on their platform is not easy, by the way. And they have
Okay.
something called the Impact Assets 50, and it's their top 50 investments. And if you're starting off, just stick with, I would stick with kind of the larger firms, right? They're generally that's safer. They have a lot of conferences, which is another thing. You can go to webinars or conferences and just start learning. What
Hmm.
did Gandhi say? Live as if you were to die tomorrow, but learn as if you were to live forever.
I did have one more question. I wanted to hear about your experience with tying philanthropy to your endeavors. We've talked about impact and doing some good around a topic that you care about. What about your philanthropic side?
So this is really cool. If you're new starting off to either investing or impact investing, I also recommend creating your own LLC. Okay, or creating your own entity. Maybe it's a trust, and then that can make the investments, right? So that's asset protection number one, right? It's not in your name. It's in an LLC or a trust or a foundation. So that's very important. And then guess what, everyone? Let's just say you do some stuff in Central America or South America or Africa. Now, when you go there to actually see what's happening on the ground, that entity, it's deductible. It's a business expense, right? Or the nonprofit will pay for it because you're allowed to go do travel and do due diligence, right? And check on your investment. So that's super cool. Everybody, don't miss that. That's really good.
That's a great piece of advice if you plan to be doing impact investing.
One of the things that I like to do, and thank you for asking this question. So last year, I was lucky enough to climb the north side of Mount Everest. Okay. And that's from Tibet. So I'm one of about 100 people in the world that have climbed Mount Everest from both the north and the south side. Okay. From Tibet and Nepal. And for that climb, I wanted to do something that would have a huge human impact. And I wanted to do something for blind people. So I normally have these really thick glasses on. I have really thick contacts in now. And if you're seeing me squinting, I still don't see that well. So the story is about a little while ago, I went to an eye doctor visit and they saw some things with my eyes. And they didn't like those things. So then I had to go see a specialist and they ran more tests and more tests. And the specialist walked into my patient room and he said, Bo, I'm not going to sugarcoat this. I've got some bad news. I was like, well, what is it? He goes, because of issues with your optic nerve, it's very likely you could go blind later in life. Well, that was a crushing blow, no doubt about it. Okay. So then I asked him, after the initial shock wore off, I said, well, what would that be like, you know, to be blind? And he said, well, if you closed your eyes right now, do you think you could find the front desk? How about finding your car in the parking lot? Right. He made his point. So for my climb up the north side of Mount Everest last year, my wonderful contributors and we brought 50,000 people from blindness to eyesight. I mean, come
Into
on, come on.
That's incredible. Where are those people living
They're
that
living
you
in Nepal, yeah, primarily Nepal, and then we did a push Belize and Costa Rica as well. But the majority of them were in Nepal, and most people don't realize this. There are there are 2.2 billion people on the planet that have mild vision impairment to total blindness.
I didn't
2.2
know.
billion. There's 295 million people that have moderate vision impairment to total blindness. And then there are 43 million people in the world that are totally blind. 43 million. But here's what stopped me cold in my tracks. I mean, my fingers froze over the keyboard when I read this. Most of these 43 million people are needlessly blind, meaning they
Hmm.
don't have to be blind. And according to the International Agency of the Prevention of Blindness, Most of those 43 million people can get their eyesight back with a simple one-time procedure that costs about $20 in most parts of the world, and it takes about 15 minutes. It's the
And
most cost-effective surgical intervention in all of medicine. Okay? I mean, come
wow,
on.
that's what you decided to do for 50,000 people,
That's right.
and your climb completely accomplished it. Ah,
Yep. And then
absolutely.
here's the part that most people miss. For every one person that's blind or severely vision impaired, right, that you can't see, there's 5 people's lives that are affected, right? Who's going to look
Yeah,
after them, right? It's grandma or grandpa, it's parents, it's a sibling, it's a caregiver. So we just didn't change 50,000 lives. We unlocked 250,000 lives. So think about this, everybody. Our success is somebody else's miracle. Don't miss that.
I love that. And I love the passion that you bring to everything that you talk about. And I really, really appreciate you sharing more of your story than just what you normally share. Thank you. Thank you.
Of course. Happy to help.
Well, this has been Graceful Investor. Thank you so much for joining us today.
Thanks for having me, everybody. Have a great day. Be a lifelong learner.
Yay. I love it. Thank you. Thank you.